I was introduced to the idea of self-insuring risk for business owners. I didn't see any value at the time leading up to '08, and then here comes the Great Recession. And unfortunately, when you first start out any business, you wear all the hats and eventually you start giving hats off. But one of the hats I always kept was working with business owners. And I remember one of my top clients owned multifamily housing, and they did okay, but there was a lot of subcontractors and general contractors, and those guys, I just saw the financial risk business owners took, and unfortunately, sometimes it was too late. They find themselves going out of business.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little. And on today's show, we have with us Van Carlson. Van is the founder and CEO at SRA 831B Admin and has over 25 years of experience in the risk management industry. Van's primary goal is to continue the upward growth of SRA and continue to develop new products to bring to market. Van, welcome to the show.
Appreciate it. Look forward to talking with you guys today and opportunity to get out to your listeners on exactly what we're doing, especially when it resolves around multifamily business owners.
Yeah, and I think it's going to be a really interesting conversation, and we're definitely going to talk about 831B plans. I want to dive into that, but first, please tell us how you got started in this field and how you got to where you are today.
Yeah, you bet. So I was a traditional insurance property casualty agent. I worked with a lot of clients, rose to a pretty high success rate as far as the industry standards, 1% performer in the industry. And I live here in Idaho, Boise, Idaho. So we're in a very fast, rapid growing area, and thought life was going to be on the easy street, build up my agency and take up golf. And then here comes '08. And I was introduced to the idea of self-insuring risk for business owners. I didn't see any value at the time leading up to '08. And then here comes the Great Recession. And unfortunately, when you first start out any business, you wear all the hats and eventually you start giving hats off. But one of the hats I always kept was working with business owners. And I remember one of my top clients owned multifamily housing, and they did okay, but there was a lot of subcontractors and general contractors, and those guys, I just saw the financial risk business owners took, and unfortunately, sometimes it was too late. They find themselves going out of business. And that's really when I said there's got to be a smarter and better way of doing a business. And the idea of owning an 831B plan, like I said, you were going to dive into those, but I saw a business owner that had 7 or 8 of these in place already. He was a manufacturer for RVs, and what he did with it, how he was able to parlay it in a way that made it he took an idea what big industries already doing this, big businesses, what we're going to be talking about when it comes to self-insuring risk. Big insurance companies, big publicly traded companies, all that, they all own their own insurance companies. There's a lot of advantages to it. We'll again get into that. But I just saw it in a way, man, it's just this idea for the small to middle market business owners needs to be brought to their attention. And so again, I appreciate being on your platform and getting the word out. And I definitely like the multifamily sector because I think there's a lot of risk that we can talk about, and how do you position that risk more effectively? Not only just change it from a risk standpoint, from a cost center, maybe to a profit center. And I'd love to get into that with you because to me, I think there's a lot of things that multifamily owners could be doing and also protect themselves against the COVID issues that came up too in the last several years because of what transpired there with rent income having to deal with a lot of different issues, political issues, all the other things that you find yourself being an owner that you're like, this wasn't in the performance. And again, it's about hedging against downturns in not only the economy, but also this unforeseen risk that you're retaining on your books. And that's what we call about, and a lot of business owners retain risk. Traditionally, you transfer that risk for fire, for example, on the multifamily, right? You're going to cover for fire, wind damage, hail damage, all those fun things, smoke damage, water damage, sudden accidental. And of course, that's getting really weirdly, oddly defined in those policies today, what's covered and what's not. Mold remediation is not covered anywhere on policies anymore, unless you go buy a pollution policy, and it's very difficult to get those things. And so these are things that you're going to retain on your risk. And I always tell business owners, like, listen, and here's what an 831B does. I guess I should tell you that first, Tim. I always forget to tell people that because I get going on the risk and I stop.
I was going to ask you, don't worry.
So the 831B is just a part of the tax code, and the tax code, no different than a 401k, right? So all that is just, if you wanted to go, if you couldn't sleep one night and really had insomnia, if you want to go read the tax manuals, you would go to 831B and you would read, okay, what does this code mean? What can I do? What that code means is really incentive for business owners, if they're going to retain risk on their books, is do it on a tax preferential treatment. No different than 401k. So basically, if you're self-insuring risk, you have an administrator like us, which is what we are as an 831B administrator, no different than a 401k administrator is. We're going to administer your plan, make sure you can elect on an 831B tax return because you're going to expense premium out of your company, no different than you would do for work comp or for coverage of your multifamily buildings. That's a line item expense under the 162. This is additional expense as well. So now you're able to create an expense, dump it into an 831B qualified plan, and that money is staying deferred. It can grow, it can be invested, it can be managed, it can be managed by a financial planner, it can be just simply sitting in a bank, but you expense it out of your operating company level, and now you dumped it into a plan that's deferring it. And the idea there is you want to build up those reserves, right? Those surpluses and everything else that comes in there with an insurance company. The box has to look and feel like an insurance company. That's where we come in as administrator and make sure that happens. So you can stay elected under the 831B. But what you can do inside that thing is significant. Specifically, what we saw in COVID-19 situations were rent income for right. So we have things for rent income protection. So if you want to set a certain dollars away where you just can't collect rents because the government says you can't, you would have that bucket of money sitting there that you would have just actually just sent off to Uncle Sam anyway. So one of the things that we're telling business owners today is we feel like every business owner should have their own PPP plan, but they should be in a position to self-fund it. And this code literally allows you to do that. This code's been in existence for 38 years. It came out in 1986, very similar to the environment we're in today. I have a Time magazine. In fact, you might be able to see it right here. You can see it on the back wall here. It's that Time magazine cover, and it says, America, your insurance has been canceled. And that was written in March of 1986 on the cover of Time magazine. And it's very similar to what's going on today. It continues to go on. And so it took about 3 years. It started in 83 and it ramped up. The market we're in today, especially with property owners having a hard time finding markets or a lot of exclusions, or they can't get capacity. Their building's worth $30 million, but they can only find $20 million in coverage. We're seeing that a lot. We're seeing hail damage being excluded, or to the point where it's not coverable because it's so darn expensive. It's hurting them. They're locked into long-term leases or rents, and they can't adjust fast enough on the rent income because of what they're experiencing on substantial increases on premiums. And so those are things that we're trying to work with business owners on, multifamily especially. And then the other one I really love for multifamily is a thing called accidental damage waiver, where we're simply waiving. We have clients that are waiving security deposits. I think if you're in a highly competitive environment where you're trying to do the first and second on a security deposit, working with the property managers, we can show them how to do an accidental damage waiver where you're just charging a monthly premium fee for that accidental damage waiver, but there's no refund in the process of that. And it's not a security deposit, so you're not going to get refunded. It also allows the new tenant coming in to pay a monthly fee versus a first and last. And we've seen really good traction in that, especially in some marketplaces.
Yeah, I think that is a real benefit for property owners because giving that flexibility to tenants can really make a difference in terms of them being able to do small monthly payments in addition to whatever the rent is, vice coming to the table with these huge chunks of cash first month, last month's rent. So that's big. But I want to dive more into what an 831B is and talk about, like, how is this different from your regular insurance? Is it really just a supplemental?
It can be supplemental, and we can actually replace traditional insurances too, based on the amount of premium you're having. So what we're seeing right now is a substantial rate increase, right? So if you have big enough premiums, we can actually go to the reinsurance markets, especially if we have a client that's willing to take on a larger first dollar risk. I would tell you right now with multifamily, the challenge is submitting any claims. Not if it's a very large claim, right? So we have a lot of business owners, property owners saying, hey, you know what? I'll take on the first $250,000 of losses. And if they're in a position to do that, if they feel comfortable with that, but what we'll do then is we'll set up an 831B and start the fund for that $250,000. Again, on a tax deferred basis, because if it happened, all you're going to do is pull cash flow out of the company anyway and pay for that deductible. But wouldn't it be smarter? And I tell clients this all the time. Do you want to use pre-tax dollars or after-tax dollars? If you're going to take on a larger portion of your risk, wouldn't it be better to use pre-tax dollars? That's why the tax code exists, for you to be able to pay your claims. Or if you're going to retain this yourself, you want to use pre-tax dollars to pay it with because you just got a lot more money to pay it with, right? And you look at coastal with co-insurance deductible, seeing a big swing up on that, right? Where not only you might only have a $5,000 fire deductible for your properties, but you're going to have a co-insurance of 30%, which if your building's worth, call it $10 million, you're gonna have to come up with, and it's complete, you're gonna have to come up with the first $3 million to get that building rebuilt. There's parts of California, or excuse me, Florida right now around Naples, that there's a lot of places that aren't rebuilt because the co-insurances are having a hard time, or having a hard time coming up with money for their responsibility. So you've got all this stuff going on. And again, if you're a profitable company, just to take a little bit off the top, park it off to the side, it's just good. Not only is it good, just good risk management, it's just good business. And so we're able to use these situations where they allow you to take on the affordability of more risk. And some of these guys with multifamily, they just have no choice. If they want, they're going to have a hard time getting a renewal policy. Sometimes they're going to take they're seeing sizable rate increases right now across the board, all 50 states, and exclusions are going up. One of the things that we saw a lot going on right now, if you have an older older multifamily building, more than 20 years, you haven't replaced the roof, they're actually actual cash value minus depreciation on the roof. So they're not even going to replace your roof in the event of it blown off by a hurricane or tornado or just a flat windstorm. When actual cash value minus depreciation on a roof, you're basically self-insuring the roof. And so these are just things that come up all the time with these business owners that says, okay, and here it is, Tim, the 831B just allows you to, code that was passed in 1986 tax reform by Congress, was revisited again in the PATH Act, because they got rid of some things there, that because unfortunately the code was being abused for things for what it wasn't designed to be, which was estate tax planning essentially. The IRS doesn't like these things. They don't think that they feel like at times they're too much of a benefit to the taxpayer. I get all that. But at the same time, it's real law. And this is real risk we're talking about that a lot of business owners, entrepreneurs, risk takers are taking on all the time. And again, how do you make it more efficient for them is by literally taking advantage of all the tools that's out there for them. And this is just one tool. This allows you, again, to take things that you would have been paying taxes on anyway under the profit model and taking a portion of those and setting them off to the side. And on a tax deferred basis, you just have more money to weather the storm. And that's a tagline of our company. We want clients to weather the storm. Storms are coming. How you handle those will be the
Yeah.
difference between surviving it or not.
Yeah. And I think I live in Florida and I've owned properties in Florida. And sometimes I think we have it worse than anybody else. But then I look around and I see we're not the only ones, right? Whose rates are doubling, tripling, finding it hard to find an insurer in the first place because so many are just fleeing Florida, for example. But it sounds like to me the biggest benefit is having that tax deferred reserve is what I'll call it, capital reserve. And help me understand with this capital reserve that I have, and how exactly can I use it? And am I the one who is allowed to decide what it's used on, and what are the parameters associated with this plan? Because I'm assuming if you use it the wrong way, you run afoul and you're no longer covered. So why don't you dive into that a little bit?
Yeah, absolutely. Great question. You do sign an investment agreement, which you can and cannot do. So a lot of times we just have clients have their financial planner manage the reserves. These are 1 month, 1 year policies, no different than you're buying your today through whoever you can find a carrier through. It's a 12-month policy. You're going to set premium aside for those 12 months. That policy expires. The company has underwriting profit in it, assuming you didn't have a claim. Now you're able to build up those reserves and surpluses in a way that, again, allows you to take on more risk or handle the risk you're having. As far as management goes, though, you control it. I should tell you, the box is a C Corp. The owners would be a shareholder of that C Corp. There's a president, secretary. It's a fully operational company within a company, but the box looks and feels like an insurance company. We administer that. We don't complicate the business owners' lives by no means. So that's one thing. But we will get a hold of them from throughout the year and all that stuff. Of course, when they have a claim, we have our own adjudicators. We either hire an independent adjuster to adjudicate the claim, assess the damages, assess the value, assess the business interruption that occurred, loss of rents, all that other stuff that goes on. And then we can submit a claim back to their insurance company, pull money out of their 831B, push it back into their operating company, and they're made whole. The biggest reason for that push is not to pull money out of cash flow on unexpected expenses. You get a couple of those back to back in a year, it puts you at risk. It's operating capital. You got to protect your operating capital. And this allows you to do that. A lot of business owners have retained earnings left in their companies. Okay, that's great. That's to create that cash flow. But at some point, those retained earnings, they become pretty tax burdensome, where you can expense it out of your company and then still drop it into these things. And again, the biggest advantage of that is you just have more money to work with, more options are available to you. And then, of course, down the road, if you decide to sell your multifamily or you no longer have the risk, you just shut these things down and you pay long-term capital gains anyway. And that's really where the advantages long-term come into play. But during the time you own these properties and you're assessing the risk that you're retaining, this makes it more efficient. So the money makes money, Tim. So we would expect this to be invested. Or, well, right now we just have a lot of clients sitting in money market accounts, to be quite honest with you. They're happy to get 4 or 5% right now with the interest the way they are. But yeah, absolutely. That money's working for you. Why it's
Okay.
sitting in there. Your 401k.
Yeah, and you already answered one of the questions I was going to ask, which is what's the exit plan for it? And it sounds like you said you collect those funds and get taxed on it, long-term capital gains, which all that makes sense. But the biggest benefit to your point that you were just raising is that while that money is sitting in reserves for any emergency that you might have, you're able to make money on that money, which is the true benefit that I think we need to highlight. Mitigating the risk in having that money available is great, but if you can make that money work, that's even better.
Oh, heck yeah. Think of this as a health savings account for your multifamily business, because you are taking on a first hire. No matter what you're doing in today's environment, you are taking on a higher first dollar risk right now. There's no way around that. Everybody's renewing either at a higher, and what I mean by that is we're starting to see sublimits come in for hail damage, sublimits come in for wind damage, sublimits come in. And then, of course, you're completely on your own with mold. All of those things we can wrap policies around and work with business owners, assess their risk, look at the buildings, and then think of it as like a sinking fund or capitalization fund. But it's being on a tax deferred basis. Those are the big challenges about building up capital sinking funds, right? All that stuff is income that allows you to build it up to where it's an advantage to the. There's so many different options you can have on the table, and I really like the idea of where they have the ability to make different decisions. And I always tell business owners all the time, the more options you have, the better decision making you can do for your business, and that's really the bottom line.
Yeah, and I guess I'm thinking about it from a syndicator's perspective, right? We do a lot of these multifamily properties under syndications. Is there special considerations associated with a syndication where, it's not just those general partners that you have involved, but you have multiple limited partners, passive investors, as we
Yeah.
usually refer to them. And what are the special considerations associated with having this type of plan on one of those types of deals?
I think the biggest thing there is depending on the ownership structure, but I've seen it used in a lot of different ways in that situation because some people want to buy out. You have the entity own the C corp, and then you can declare dividends if you wanted to out of that C corp. And that actually goes towards help buying a partner out if they want to buy out without having, and you can redistribute it back out to all the other partners. You're probably doing that already right now. If I forget what they call it when somebody just wants to buy out, remorse, whatever goes on in the world of their lives, right? Life issues where somebody says, hey, I don't want to be part of this anymore. Can I be bought out? And there's certain provisions you guys put in the agreements and all that stuff. But to be able to have those funds to be able to do that with are pretty nice too, by the way. The other one is I think business interruption is huge, meaning that some of these folks start to live off the income these things are kicking off. And all of a sudden they got a contraction of rent due to one reason or another, like it's not necessarily economic downturns because it's more of a business risk. But I think COVID-19, I keep directing back to COVID-19 and here's the thing, the government stepped in and did a lot of things, right? They came out with ERC, they came out with PPP and all these other things. But the reality is I don't know if we should be relying on that, nor I don't know if that's going to be there the next time. And let's hope to God it doesn't happen next time, right? But I think that's another income protection thing that you can put in place that, hey, we're going to put these profits away for the time being, build them up in a tax deferred bucket of money. And if it happens, we're gonna at least be able to keep our nose, minimize the capital calls coming in when there's unexpected disturbance in the cash flow of the rental incomes. The bigger thing too, I think, it goes towards when something happens, there's a good chance you could have a capital call. I mean, if I'm misspeaking on that, Tim, please tell me but if all of a sudden the business owners had to come up with an extra $250,000 of a deductible or a co-insurance deductible of 20% on a $5 million building, they got to come up with $1 million. That $1 million isn't sitting around somewhere. They're going to be called in for a capital call. So again, any of those things that you can soften those blows on by utilizing a program like this, just to me, it makes the investment stronger. Truthfully, I see it.
Yeah, and that's a great example that hopefully we can dive into a little bit more. You mentioned capital calls, which unfortunately is something that's ever more common right now within the multifamily industry just because of the unprecedented rate cuts, et cetera, et cetera. And so I guess I'm wondering how we'd be able to use this for that problem, seeing as how, hey, rents, like you said, rents going down, that's more of a business risk. But how would you be able to get access to those funds? Because I can't really put an insurance claim in when, rents go down or occupancy goes down, could I?
Yeah. So depending on the structure of the ownership, but a C corp doesn't pay other C corps as dividends. So if the company owns that C corp and they declare a dividend, those monies flow back into that C corp and they're using it for expenditures. Obviously, you're offsetting expenses anyway. There's a lot of you can't necessarily use it. And again, if it's an insurance claim, obviously that's pretty black and white. Insurance claim, hey, we got to come up with certain first dollar losses. That's pretty. But it's when you have to replace the roof because of the wear and tear on it or something like that, where it's just time for it to get replaced. You can use a portion of those funds to a dividend situation. Obviously, again, based on the structure, there's a lot of creative. In fact, I meet more creative people out of Florida when it comes to the way they structure ownership than anything I've seen in the recent years. But so there's just a lot of those things that play into it, Tim, and those are one-offs that we would probably have to sit down with the client trying to figure out what they're trying to solve for. But to your point, a lot of it's business risk. I like the accidental damage waiver because I do think it's an additional revenue maker for the building owners. Right now, they don't get any of that money because typically they hire a property manager, they get all the security deposit. If you offer an accidental damage waiver and waive the security deposit, you're charging. We had clients charging $80 a month. Now, after 12 months, they might go down to 60. After 3 years, or excuse me, and then after the second year, they might go down to 40. But those are premium dollars that are being collected every month off those rents over and above the rent income. Now you can scrape that out, scrape it out, dump it into your 831B plan. Your operating company is not picking it up. And when they do have claims, meaning when the person moves out and there's damage done to the apartment, holes in the walls, carpet's got to get replaced, they submit a claim against those dollars. But the cool thing about that is ease of operation, no refunds. When you talk about property managers and owners of multifamily, they're giving 50 to 60% of those deposits back. It's an administrative nightmare in a way. From what, talking with somebody that owns several thousand doors, it's a full-time job for many people. And then two, the other one is making sure they have insurance. That alone, to upkeep on that can be very tiresome for a lot of business owners, especially a lot of property managers, because people go in and out of force all the time. And again, this is busy work. It's just part of owning the multifamily business. But if you can just put an accidental damage waiver in, or charge tenant liability to them and bake it into the rent, you're getting rid of that administrative cost because you're already covering it through your own channels. You don't have to worry whether or not they have renter's insurance or not. It's being handled through the policies and stuff at work that we can put away. And again, most business owners would never do this because they don't want to take on the risk. But if they can charge the premium to the tenant and then scrape it out of their operating company, not as additional income, they could take some of it out for administrative costs, but let's say the income, and they can scrape it out, expense it, and now dump it into an 831B and have it build up tax deferred. It's just more appealing to them to want to do. Does that make sense what I'm saying?
Yeah, I think it's just another creative use of the fund, if that's the right word. Plan. Sorry,
Yeah.
plan. I guess that makes me curious too about how the traditional insurance market looks at a plan like this. And is it something that's favorable, right? Do they look at this and say your risk is reduced because you have a plan like this in place? Do they not care? Or what is the thought process from the perspective of traditional insurance?
I think we're a competitor against traditional insurance. That's the way they would see it because we do replace traditional insurances as well, especially when
Mm.
it comes to property. It's still a tough market, but you still have reinsurance carriers out there based on the type of risks we're dealing with, type of building materials and all that. Where you're at in the like Intermountain West, the Rocky Mountains, multifamily is still not getting hit that hard. Any place that's subject to catastrophic
Mhm.
losses are going to, and Florida is a good example of that. And two, market constraints. Remember, market people are just getting out of the markets altogether. There's another big announcement out of California this past week. State Farm's non-renewing 72,000 homes. They were not taking on new business. Now they're simply non-renewing. And I know you've also got the same things going on in Florida right now, even with residential homes. Just trying to, even in the sales process, even trying to find affordable insurance is sometimes killing the deal to sell your house or not. And it's just becoming problematic. I can't imagine what that looks like on multifamily right now if you're trying to sell your property. And it's going, obviously, it's going to hit the cap rates pretty significant when you all of a sudden you have a higher cost and premiums. So to me, then we come in as a solution maker and say, listen, it costs 40 to 50 cents to run these insurance companies. So I give you $1 in premium. They're using 40 to 50 cents of that just to run the company. pay the agents to do all that and keep their names on the buildings. The other 50% is really designed for paying claims. And when they go and they exceed that 50 cents is when they claim they're losing money and they have to dump into their surplus. So we'll come in and say, listen, I got a carrier that will take on that 50 cents. You retain the 50 cents yourself, but understand you're on the risk for that. So now you can be, especially if you have efficiencies of scale, which we bring the table to the business owners that own multifamily units. At some point, they're parallel and then they cross. And when they cross, the business owners just got to decide, am I willing to take on more risk and enjoy the profits that the insurance company was making off my dollar anyway? And I retain that risk. I'm willing to bet on myself. And for the right client, Tim, I would tell you, and for the right investment group that just says, hey, this is painful. Can we just go self-insured risk? Think of it as a level funded healthcare plan or a self-funded healthcare plan, or we're seeing that more and more around the country with general liability, property, commercial auto, all of those things when they're going up in rates, no different than the healthcare was going up in rates. More and more business owners were looking at ways to self-fund. And I would tell you, self-funded healthcare plans are happening all over the country. If you have 100 more employees, you should be looking at it because the dollar, it just, the numbers do what the numbers do. And same thing for this situation. As property costs go up for the premiums and the limitations you're getting, is it better to take on a bigger risk yourself? Because you already are doing that. Because think if you had a claim, what would happen to you next year anyway? Do you really want to submit the claim, right? So again, if you're having these issues going on, and I can't iterate enough, would I rather use pre-tax dollars or after-tax dollars to fight the fight? And I'm just telling you, mathematically speaking, you have a lot more dollars to work with on the pre-tax basis, especially if it's working for you. You're putting in an investment, and now you're really getting what insurance companies live and breathe to do, and that's investment income off the reserves and surpluses that you would have just gave away to Uncle Sam anyway in the form of a tax. Again, efficiencies of business models, and this is why big companies have adopted this. I can tell you, if you're in a big REITs, all those guys, these guys are doing all this stuff. Big business. This is a big business tool. We're trying to price it in a way where your mom and pop, your normal investor on the street that's participating in your type of investment pools can participate as well. And I think we've done a good job with that. I think the fact that we have 800 participants right now in our plans, 800 active plans, and we're on track to double the next 3 to 4 years. And we're excited about the space we're in. Obviously, we're geeked out risk managers, but we understand the tax code and we understand that what needs to happen to make sure our clients are protected on that. But we're going to sit down and visit with the business owners, find their pain points, and see if we have a solution to their problem when it comes to their overall insurance program. And then we also look for things that they're not covering. How do you want to cover that more effective and efficiently?
Yeah, and it sounds like your approach is very custom. Every person or business is different, and so you have to look at the risk scale, et cetera, associated with that. But is there a general threshold at which it makes sense more than others, in terms of scale, whether that be value of the assets or number of employees or whatever the case may be? Is there some determinant that people can use in their own mind to think
Yeah,
about when they should start thinking about this as an option?
Yeah, I would say when it comes down to their deductible, what their deductible exposures are, and then two, what they're already paying in premiums. So if you're paying north of 100, our sweet spot's over $250,000 in premiums. When we can really start to we can show a client saving 125,000 of that. Now again, they're going to be taking on more risk. Again, are you willing to bet on yourself, or are you going to pay for the tenant? You're going to pay for the property manager down the road that maybe not be taking care of the properties as well as you are. You're a much better risk to the insurance carrier than your competitor down the road is. The way you manage, the way you handle, the prevention you put in place, the type of shrubbery you use, and all the things that you do to make yourself a better risk, not only from an insurance company standpoint, but from just simply a business management standpoint. Why wouldn't you want to at least look at, does this make sense to go self-insured? The other thing is we're getting into a thing called a named peril. Single name peril. So let's say it's killing me on the wind. I don't want wind coverage on my traditional insurance, or I don't want hail damage covered on my traditional insurance. I will help clients set up a single name peril policy, they call it, and they can self-insure for that. And I can actually find reinsurance markets for that will just reinsure that piece of it, but we'll still keep the fire in place. We'll still keep the sudden accidental water damage in place. We'll still keep the general liability for their tenants slip and fall, and then business interruption on that. But when you're looking at single peril policies, what I mean by that is single peril loss, potential loss. It's either hail, good examples. Flood insurance is a standalone coverage now, but right, based on FEMA. Nobody's selling you flood insurance along with your habitational policy. That just doesn't exist. You have to go buy that by itself. We got clients now buying that with earthquake was another good example. But now we're seeing the hail coverage and also wind coverage now, where it's just single name peril policies. That's all they're going to buy, and that's all they're going to self-insure for. but they're able to lower their premiums down on their traditional insurance significantly because they don't, then that traditional insurance company is not on the hook for those coverages. That's a great way to manage the risk overall, especially I think we're on a 10-year cycle right now based on historical facts from the 80s that business owners that own property are probably going to be looking at this kind of a thing for the next 10 years until the market recorrects and does its thing. But yeah, we're just in the beginning of this, unfortunately.
Yeah, and so this definitely gives people something to think about because there isn't a multifamily operator that I know that doesn't think about insurance because it's become one of the biggest challenges with making a, like you said, a deal work just based on the numbers. When it comes time to renew, how is that going to impact profits, etc. So definitely something to think about. One thing you mentioned that piqued my curiosity was you said that the IRS doesn't like this type of plan. I wonder sometimes when we get these new or more innovative types of plans, it garners a little more interest and oversight from regulators. What does this do in terms of bringing undue attention from the IRS? Does it bring a higher rate of audit, for example, on when we have a plan like this?
I would, based on my experience, no. But that doesn't mean that's not the case. I think we do a pretty good job. My competitors are typically CPAs and attorneys, and they're out promoting the tax code in front. They put the tax code in
Mhm.
front of the risk management. We don't do that. We're not that sophisticated. We recognize the fact that there's tax advantages to it, but we talk about risk. And so that's one thing. I always tell clients, hey, I don't know that crystal ball, but here's what I will tell you. If you're doing this for the sole purpose of lowering your tax liability, then worry about an audit. If you're doing this for true risk management strategies that you know you have on the books, we know you have on the book, and you're trying to make it more efficient for your stability of your business, then I would tell you to sleep easy at night. They may come, who knows? But I will just tell you that if your motivation, your intent is sincerely, hey, everybody's motivated about saving taxes. That's why Congress passed the code. Back in 1986, actually, farmers were self-insuring crop insurance, and business owners that own properties and buildings were having the same issues we're having today. That's why the code came into existence. Congress recognized that we as Americans have a lot of incentive to save money, and they're the ones that create those incentives in front of us. I tell people all the time, if you as a business owner, would you offer a 401k if you couldn't expense it out of your operating company level? They go, no, I wouldn't do that. Of course you wouldn't. Guess what? Congress says, hey, we'll create an incentive for you to do that. Now you have an incentive to save money, taxes, defer it, and handle your risk more effectively because you can't buy or transfer that risk to a traditional insurance carrier. Or even if you could, it's so darn expensive, it kills me anyway. There's no risk reward there for me. Somebody told me a long time ago that our tax code has probably created more wealth than anything we've ever done. And the best example I give is look at the 1031 space. Think if their 1031 didn't exist in our country, what would our real estate be worth today, relatively speaking? Because there'd be no people would be just the risk reward wouldn't be there. But meanwhile, if I'm going to sell my property and I can take on more risk, get a bigger building, get a bigger rent income, and all the things and all that into another 1031, I'll take that risk. There's some people that, oh my God, they're risk adverse. God bless them. Be a CPA, right? God bless you. Go become a CPA. But if you want to be a risk taker and own properties, you're going to do 1031s because, hey, I don't want to pay this damn tax bill. I took a lot of risk to get where I'm at. I can go into another one. I'll do that. But think if that code wasn't there, it would make it very difficult to sell properties. But meanwhile, what did that do? That created a lot of wealth in our country based on that tax code alone. I'm a firm believer in that. I've experienced that myself. I've done well in the past with commercial real estates, and I'm like, dang, if I don't do something with this, I'm going to get killed. And meanwhile, I could have gone the other way, and nobody would have cared. But now that I won on this one, I'm going to get hit on taxes to the point where again, you lose your value, or you want to. Do I really want the hassle of doing this? I think the 1031. So not to beat that up too badly, but every code will bring attention from the IRS. Why? Because they're tasked with collecting as much tax revenue as possible. Again, if your intent was correct, and the other thing is don't try to bite the apple twice. I've seen a lot of our competitors get really cute with the reserves and surpluses in the back room. God bless them. But we stay in our lane. We're risk managers. We're going to help you. We're going to make sure that money can stay deferred under the 831B tax code with the risk management. And we'll work with your financial planner. We'll work with your state attorney. We'll work with your CPA in the back room and how that money can be used and operated and everything else. And of course, we think money should make money. I mean, all that stuff. But we're going to have those conversations with those trust advisors and they go manage it. We're not going to manage it for them. It's the client's money. whoever owns the C corp. One of the things that this thing was being abused for, Tim, was estate tax planning. And really what was going on, there's 3 or 4, now there's probably 5 cases the IRS has won in the last several years. And it was all motivated from estate tax planning. These are C corps. They're going to make it irrevocable trust. Their kids own them. They're going to get around gift taxing, estate taxing, because they're going to draw down their estate. And of course, when grandma and grandpa die, the grandkids get the shares of the C corp. And great planning, fantastic planning, too good to be true kind of planning, right? In 2015, in the PATH Act, the code came back up. They got rid of the lineal descendants. So if you don't own the operating company, like in this case, if the kids or lineal descendants don't own some kind of form of the multifamily, then they can't own they cannot own the 831B plan that is part of ensuring the risk of that operating company. So they got rid of that. But what they did at the same time, though, when it first started out, it was only 1.2 million you could put a year into this thing on a tax deferred basis. They moved it to 2.2 in 2017, became permanent law under the PATH Act, the 2.2 million, and then with a CPI rider. So I guess there's one good thing about inflation. But today you can put $2.8 million away in this thing every year. Now, that's the top level. There's rules you have to apply for. There has to be a methodology to the premiums. Or again, there's a 4-part test to owning these things, staying elected in an 831B tax code. We as administrator make sure our clients adhere to all that. So as long as you're doing those things for the right reasons, I think you can sleep pretty easy at night that it may trigger an audit. But what's funny about audits, and I've probably had 50 operating company gets audited just because of the amount of clients we have, and they've made the phone call and say, hey, my company's being operated. No 831B that we manage has triggered an audit, but operating companies get audited all the time. And so we get a call up. But what's crazy is I bet you 50% of the time our business owners have gotten a refund. So I always wonders, I don't know if an audit's, I don't know. If you're doing something shady, then whatever. But if you're just being an honest taxpayer and trying to play by their rules and play the game the best you can, and you have real good tax folks around you, I think you can sleep pretty easily at night knowing that you're taking advantage of all the tools that's available to you.
Yeah, and that all makes sense. Like you said, doing the right thing, making sure that your team is in sync with each other. Those are the 2 keys right there to staying out of trouble, and you shouldn't have any problems. This has been some really interesting conversation, and we dove pretty deep. But now it is time to go to the turbo round. So I'm going to ask you 3 questions that I ask every guest that I have on the show, and I just ask for a quick, honest answer. Ben, are you ready? All right. First question. What is one red flag every investor should look out for?
The transparency of who's in front of you. I think you go with your gut instincts a lot of times on the people you're working with. Due diligence today can be done probably easier than ever. And don't get complacency. Don't get complacent with your dollars. I think you work pretty damn hard for them. And I live in the world of trust and verify. I know that might be an oxymoron to some folks, but I give trust, but sometimes verification is just as important. And you want to be able to do that. And so I think if you can't get that verification or that warm and fuzzy feel, there's probably a reason. And go with it.
Transparency is huge, but that due diligence is necessary. All right, second one. What is a myth about this business you would like to set straight?
That you brought up that if you do participate in these programs, you're going to get an audit. I would tell you CPAs, God love them. Like I said earlier, they're pretty risk adverse. That's why they're in the industry they're in. And a lot of times they apply their risk tolerance to their business owners.
Sure.
And meanwhile, the business owners I work with that own multifamily, they're 100% risk takers. And meanwhile, I say it very clearly a lot of times that CPAs only lose sleep when you're not paying tax. They don't lose sleep when you aren't paying tax. And so that, to me, that's one of those things where this isn't triggering audits. I think it's great tax planning. At the same time, more importantly, it's just straight out good business management and risk strategies that your competitors are doing and your big companies are doing. It's natural as putting your pants on one leg at a time. And so for me, that's the myth. Unfortunately, a lot of CPAs like to portray out there that it doesn't exist. We haven't seen it.
All right. And last question. Van, what does success look like to you?
Success looks like to me on a personal, financially and all those things, that's great. But I would say on a professional level as a risk manager, one of the greatest joys I took that I didn't see coming, but it happened by several clients now over the years is, Van, I just sleep better at night knowing I've done your program. And I think from a risk management standpoint, that's true success. I sleep like crap. I think most Americans seem to not sleep that great. And anytime I can improve somebody's sleep, I'm happy to do that. And I would say from a professional level as a risk manager, being told that is you're professional. And it raises your level of professionalism. And I think that's a great place, and that feels like a lot of success to me.
Yeah, absolutely. Helping people sleep at night. It's underrated. I'll say that for sure. So knowing that you can help people do that is huge. All right, Van. So, hey, I know this has been my introduction to 831B plans. So I certainly learned a lot, and I know the listeners did as well. Please tell them if there's anything else that you'd like to share with them and how they can get a hold of you.
Yeah. Hey guys, this is just another tool in the toolbox. As business owners, we got to look at all the tools that's available to us. And again, for the right client, it's a fantastic tool. It's no silver bullet by no means, but it can be a great tool at the right time. 831b.com is our website. I would recommend you start there. My name is Van. So Van at 831b.com. Happy to respond to emails. But going to our website, a lot of educational videos are there and really get to learn more about it. It's one of our taglines is weather the storm. And like I was saying earlier, think on the earth, storms are coming and how do you want to weather them? And I think this is something that you owe it to yourself. You owe it to the risk you took to own the properties you own. And like everything else out in life, it's something you got to think about and work on and set it in. And I just think if you're to a level of where you want to just take some risk off the table and not double down all the time, this is a great tool for you.
All right, Van. We'll definitely have all your contact information in the show notes. I appreciate you coming on, and I look forward to seeing you do big things on your journey to multifamily millions.
Thanks, Tim. Appreciate being on your show.